Banks kicking off another earnings season with JPMorgan, Wells Fargo, Bank of New York Mellon, all reporting solid quarterly results. But how long will good times last as lower rates make their way through the financial system? For more reaction to today's earnings, we're going to bring in David Ellison, portfolio manager at Hennessy Funds. David, it is great to see you. So let's start right there. Those banks, they reported results, Dave. Give me your take on those results. Did anything surprise you, Dave, in those reports?
Not really. I think fundamentally they're pretty much in line with what everybody thought, which was sort of a no news quarter in terms of credit and margins. I think the issue is that the big thing is rates have stopped going up, and so they're coming down a bit, taking pressure off deposits. That's helping margins. Credit's fine, but I think the big thing is the mathematics of the business is working in their favor for the first time in a while, meaning that they're growing tangible equity, they're buying back stock, and the book value is growing. So JPMorgan had an 18% year-over-year growth in tangible book. Now that's being helped obviously by earnings and being helped by the recovery or the decline in rates, which is helping the hit on asset that they had. So then that's going to continue. So the point is that you're growing book value at that rate. It's going to continue to grow roughly at that rate. And you could argue that's the same thing for a lot of the other banks. Obviously, the numbers will be different, but we haven't been in a situation where book value has been growing for a while. And I think that's a big part of what's happening here. I think second thing is, let's remember now, JPMorgan is a $4 trillion bank. The Fed's balance sheet is only 7 now, down from 9-ish. So the point being is that the banks are becoming a much bigger part of how the Fed is going to fund the government and how the Treasury is going to fund the government. And that's a value creator for them. And you throw on the fact that the market's at all-time highs, Wall Street is open, they're generating a lot of fees. So this is a bank that is, poised to become a very important player in the financial system worldwide, and be a partner with the Fed and not be sort of run over by the Fed. So I think those are the things that I see, is that, the Fed is shrinking, the banks are getting bigger, and because of that, more important and more profitable because of it.
Dave, to get back to net interest income for just a minute and zero in on that, not just for JPMorgan, Wells Fargo having sort of a similar experience. As you mentioned, with rates going down, with the Fed cutting rates, it means that these banks have to pay out less on deposits, but at the same time, they're collecting less on loans. And there were some questions going into this quarter how that was going to sort of balance out. Is that too balancing out in the bank's favor, and not just these two banks, but the ones we're going to hear from next week?
Well, it's in their favor as long as rates don't go down too much. I mean,
what's too much, Dave?
Well, too much would be to get, let's say, down to 2% or 1.5% or below 2% on Fed funds, because then your prime is going to be 5 or 4, and that's no good. And so I think that I know we're picking numbers, but I think it's a 3-4% cost of funds and a 5-6-7% yield on assets is kind of the sweet spot. And the hope is that you can stay there. The other thing is that, the banks have gone through a significant increase in rates and therefore loss of market value. That's coming back, and they're going to reposition and not want to go through that again. So, but I don't think it's all about NIM. I think there is the structure of the deposits, which, everybody worried about with Silicon Valley, and that's still out there. And so it's not so much the cost of your deposits, it's the structure and where's the next deposit going to come from.